How you doing there, ladies and gentlemen? As you can see, today we're in another beautiful hotel, but rather than point out the obvious as we walk through, we're going to start off on Stock Market 101 today. So, as we go through the first couple minutes, it's really a couple minutes of extra footage. I'll just tell you that I've been in the stock market observing, participating, and learning for over 30 years. And I'm pretty good at it, and I want to share a lot of information with you as we go along, and eventually I may do some day trading live. I am an active trader, not a long-term investor, and starting at 15, 16 years old, I started reading my father's library of investing and mutual fund books, moved on to Business Week when I was in the military, and eventually opened up an account with $500 with Ameritrade back in, I don't know, the beginning, first stages anyway, of the internet bubble, called the top in the housing bubble, and I've done real well. So that's not to brag or boast or anything, it's just to give you a little history and for you to realize that you're talking to somebody near 60 years old that spent his whole life in the market and really does know what they're talking about. And I'm certainly open to differing ideas, and if your way of trading is different and works, that's great. And I wanted to real quickly mention that in this video you'll hear my sort of top three beginning things that are necessary. And when it comes to participating, I just sort of glossed over it, but it's not as dumb and obvious as it seems. I don't mean participating by opening up an account and putting some money in it, adding to it, dollar cost average, whatever, and that's the end of it. I mean that there are going to be times that you need to participate, which is why I brought up the coronavirus spiel, when you don't really want to. And we'll get into more of that later as we go along, but the meat and potatoes of the video is about to start. And thanks for watching, folks, and please comment and tell me how you like this setup for stock market videos. Well, this is the back side of the hotel, or front if you like the beach, I guess, and I'm gonna walk up to the hotel from the back here to give you the grand tour. But rather than talk about the hotel, I thought I'd start talking about the markets and investing, as that's what I'm going to be changing my channel to. So you can enjoy the hotel and we'll do Market Investing 101. And on that note, the number one thing that will make you profitable in the stock market is participating. If you don't participate, you can't make any money. That is the most important thing. Cough yourself up 10 bucks, join Robinhood, you pay 0 commissions, join something else at 0 commissions if you want. I don't care what it is, but start participating. The very next thing that is the most important is to get a risk profile that's consistent with your own personality. And what I mean by that is I have a personality where I am not satisfied with doubling my money every 10 years with a 6% or so rate of return. So if I were to invest like Warren Buffett and be a long-term investor, much as that might work if my personality was such that'd make me happy, I'd likely get bored and dissatisfied with it, and I would stop participating. To me, if I have 60 grand and all I'm going to get is 120 in 10 years, I'd rather take my 60 grand and buy a Camaro and drive around at 200 miles an hour for the next 10 years, rather than wait and buy another car for 120 grand and drive them. But if I can invest more aggressively and maybe make $200,000 or $300,000, then it's going to keep my interest. You may be the other way around. You may decide that what you want is just to double your money and sleep well at night, and that's just fine. But when you start investing outside of your personality, you start to make a lot of mistakes. You'll get scared because you overinvested. You'll get bored because you underinvested. And that's when the mistakes start happening. So, number one, you have to participate. And number two, you know, use the old expression, you can't, don't bite off more than you can chew. And don't invest so conservatively that you get bored out of participating, okay? And quite frankly, the stock market is the great equalizer. If you're just a normal, everyday person like me, and you start participating, slowly over time, I don't care what kind of regular blue-collar job you have, through saving, through investing consistently, eventually, you're going to double your income compared to if you did not invest. So I don't care if you're a fry cook, a high-paid lawyer, whatever you are, you should be investing. And you'll find that in the beginning, all that money you could be spending on your new Camaro, as it were, kind of sucks. But once your new Camaro money starts profiting and you start realizing that you're going to have a whole lot more money down the road, all of a sudden it becomes worthwhile doing. We're in the Italian restaurant now, by the way, taking a shortcut to some of the other pools. But I had a pizza here last night and it was real good. Guess I'll show you a shot of the kitchen. The cook was kind of cute. Sawasdee Cobb. Okay. So where was I? Participating and making sure that your risk profile is correct for the way you're investing. Right? Okay. I'm going to pause it here for a minute to collect my thoughts and walk down this alleyway here. So here's a cool kind of area we'll walk along and talk. The next most important thing is to treat yourself, regardless of how smart you think you are, as the average person. Because the average person, statistically in the stock market, makes a horrible number of mistakes that are frankly hard to understand once you've been in it a long time and you stop making those mistakes. But if you don't treat yourself that way and you think you're smarter than everybody else, when you make those mistakes, you're going to find a reason other than you made a mistake, and you're going to continue to make them. This is, by the way, an outside massage place where nobody's getting massaged at the moment. So I'll give you a good example. There's a guy named Cheap Charlie who does Thai videos, and he made a video about the falling Thai baht, and my response to him was trying to teach him something, that when non-experts and just casual people start noticing, say, gold at $2,200 or a big drop in the Thai baht, and they start coming up with their non-expert opinions and explanations as to why things are the way they are and why they're going to continue, that is a really, really good sign of a market top or a market bottom. And rather than Cheap Charlie saying, wow, thanks a lot, I'll keep that in mind for next time, he did exactly what most people do. He said, well, it wasn't my fault that I didn't know the coronavirus was coming. It wasn't my fault this, it wasn't my fault that. I wasn't trying to say it was anybody's fault. I'm just pointing out that by the time average everyday Joes notice things outside of their areas of expertise, either the top or the bottom has already come. So why am I bringing this up? Is to give you a relatively recent, by that I mean a week old, example of what happens in this kind of situation. Now, the coronavirus came along, and anybody who's been in the market very long at all should know that these types of events are very short-lived. It's another nice little pool. Wife and I swam in. Oh no, we swam in the lower one last night. Anyway, the coronavirus comes along. There's like 200 people that died, and I don't know, there's 6,000 that were sick or something. Compare that with the 25 million that get the flu and the 80,000 that die of it in America each year. Why would you freak out and panic? That doesn't make much sense. Yet the stock market, of course, dropped 600 points in one day. What that means is there are a whole bunch of people selling that should have known better. And then there are people like me that know better that were picking up bargains and buying. I bought on that day. It's already less than a week later, recovered all 600 points, made 200 or 300 more, and I sold what I bought at that little bottom at the top, and I'm moving on. Other people are going to do what they consistently do, which is get scared out somewhere along that 600 point drop, wait for it to bounce up 300 points more. So essentially what they're going to do is buy a $100 stock, it drops to 80 and they sell it. When it goes to 110, they're going to buy it back. Means they lost $20 and they're buying in at a $10 higher price than they bought before, which if they had done nothing, they would have made $10. That's extraordinarily common, and I'm going to tell you exactly why in just a second after I pause it and catch my breath here. Okay, so I'm going to explain to you as we walk through this little garden area real slow the biggest psychological problem and why people sell at the bottom and buy at the top. The short answer is because it's about 10 times more emotionally painful to lose money than it is to gain money. So what happens, and I really want you to understand this and think about it, the stock market goes up 8 out of 10 days. So you would think, well, there's 2 down days, there's 2 up days, they cancel each other out. That leaves 6 days to be happy. Well, if it was all equal, that would be true. The problem is that the 2 down days add up to 20, the 2 up days add up to 2, and the other 6 days don't cover the rest of the 20. So what that actually means, and this is kind of astonishing if you think about it, that over a 10-year period of time, if you're a buy and hold type investor, you could expect somewhere between 8 and 10 years to double your money. But even in the process of doubling your money, you're going to have a negative happiness quotient. So even though you have twice as much money as you had before, you're actually a little bit sad. Because all those corrections, all those times when the market went down were so much more emotionally painful than the slow process of it going up. And part of the reason is because the market drops much faster than it goes up. But that's not the entire story. Even on an equal basis, on a dollar for dollar basis, you still have that same problem. But it's exacerbated by the fact that it goes down much more in one day than it goes up generally. So when you think about that, that is the reason people get all emotionally flustered during the times where they have this essentially emotional pain because the stock market went down, which leads to bad decisions, which especially if you're investing above your personality, you're over-margined, over-invested, you're investing in stocks like Tesla that might go up 100 points and down 100 points, and you just can't, you thought you could withstand down 100 points and you find out you're wrong. Then that whole problem gets exacerbated even more, and you're going to get tempted to sell the stock out because you're afraid. And all that emotional pain will go away if you just sell your stock at the wrong time. And then when it starts going up again, you say, well, I felt a little bit good when I was making some money, so I guess I'll buy in again now that it's going up. And that is exactly why people do that over and over and over. And the obvious question is, how do you avoid that? And the answer is you avoid it, by knowing that it happens. But more importantly than that, is you have to recognize that you're an average person, even if you're not. Just like a lot of you, I like to think I'm smarter than everybody else on occasion. I certainly like to think I'm smarter than the average person. But if you treat yourself as though you're not, you won't come up with those cheap Charlie excuses of how it wasn't your fault that you predicted things were going to keep going down and you were wrong. You'll say, oh, I guess I did what the average person did, which was make a mistake. So, let's wrap this up for now. And what are the three things again? Number one, you have to participate. Number two, you want to make sure you're investing in accordance with your own personality, not with somebody else's personality that does really well in the stock market. That won't work. And the third thing you have to make sure and do is make sure that you understand you're an average person and you're going to make average mistakes. Otherwise, you're going to start blaming your mistakes on 10,000 other irrelevant nonsense stories, and you won't be able to overcome those mistakes over time like somebody who admits they're an average person and made a mistake will be able to. So there you go. I don't know how much more video I'm going to make. I think those three things are enough for my first video. And if you guys enjoyed the basic stock market talk with scenery, let me know. If you'd rather see charts and graphs and stock market-y stuff while I'm talking, let me know that. Thanks a lot. Please subscribe and enjoy. Thanks.